With everything that we are hearing in the media today about bank failures, particularly around the situation that occurred with Silicon Valley Bank, it's more important now than ever to be mindful and prudent about our finances. In today's video, I'm going to share with you 3 important frugal strategies you can apply today to safeguard your finances. So let's dig in. What is a bank failure? A bank failure is a situation in which a financial institution becomes insolvent and cannot repay its creditors. Banks are subject to many regulations, but when they fail, it's usually because of fraud or mismanagement by their owners. Bank failures can be devastating for customers who have money deposited at the bank, and even more so if they don't have access to their funds immediately after the failure occurs. In some cases, customers may not be able to access their funds for months after a failed bank has been shut down by regulators or liquidated by other institutions that buy up its assets at auction. Therefore, it is important to prepare for such situations in advance. Now let's talk about frugal strategies to keep your money safe. Step 1. Create a financial plan and a budget. Financial planning. One of the best ways to prepare for a bank failure is to create a financial plan. This plan should include a budget that outlines your monthly expenses and income. By doing this, you can identify areas where you can cut costs and save more money. This extra money can then be used to build up an emergency fund that you can use in case of a bank failure. Having an emergency fund will ensure that you have access to cash when you need it the most. Creating a budget. A budget is the first step to saving money, and it's easier than you think. Simply write down all of your expenses for the month and then compare them against how much money you make each month. If there is any excess left over after paying all of your bills, put that amount into savings for an emergency fund first. Then invest it in something like an index fund so that it can grow over time. Win-win! This way, you are covered for the immediate future as well as creating wealth for your long-term future. Step 2. Maintain an emergency fund. An emergency fund is a key component of any financial plan. It is a pool of money that you set aside for unexpected expenses. This can include things like medical bills, car repairs, or home repairs. In the event of a bank failure, an emergency fund can be a lifesaver. It can be used to cover your living expenses until you have access to your funds again. Experts recommend having at least 3 months' worth of living expenses saved up in an emergency fund. We recommend you save up at least 6 to 12 months of an emergency fund. This way, you are well protected in case it takes your bank some time for you to be able to access funds. Side note, be sure to have some of your emergency fund liquid. Step 3. Understand FDIC insurance. The Federal Deposit Insurance Corporation, FDIC, is an independent agency of the federal government that provides deposit insurance to protect depositors in case of a bank failure. The FDIC provides insurance coverage of up to $250,000 per depositor, per insured bank for each account ownership category. This means that if your bank fails, your deposits are insured up to $250,000. It is important to note that not all banks are FDIC insured, so it is important to check before opening an account. If you like what we are sharing, be sure to hit the like button and be sure to subscribe to this channel for some savvy, smart, frugal tips. We love having you here. Here's a few additional frugal strategies to keep your money safe. Pay down debt as quickly as possible and avoid taking out new loans. Debt is one of the biggest drains on your finances because it forces us to spend money on interest payments instead of things we actually want or need. So get rid of those debts ASAP. Automate savings into 401ks, IRA accounts through payroll deductions if possible. Otherwise, set up automatic transfers from checking accounts into investment vehicles, such as mutual funds every week, month, quarter, depending upon preference. This ensures regularity without requiring extra effort from yourself beyond initial setup process itself. Diversifying your savings. One way to protect your money in the event of a bank failure is to diversify your savings. This means spreading your money across different financial institutions. By doing this, you reduce your exposure to any one bank. If one bank fails, you still have access to your funds in other accounts. This strategy can also help you earn more interest on your savings. For example, if one bank is offering a higher interest rate on savings accounts than another, you can move some of your money to that bank to earn more interest. Low-risk investments. Another way to protect your money is to invest in low-risk options like certificates of deposit, CDs, or bonds. These investments are less risky than stocks and they provide a guaranteed return on your investment. CDs are a type of savings account that requires you to keep your money in the account for a specific period of time. In return, you earn a higher interest rate than you would with a regular savings account. Bonds are loans that you make to a company or government. In return, you receive interest payments on the loan. Consider investing in gold or silver. Investing in gold or silver can be an important part of a diversified investment portfolio. Gold and silver have historically been used as stores of value and hedges against inflation, economic uncertainty, and currency devaluation. Gold, for example, has been shown to remain strong in difficult financial environments and to hedge against inflationary declines in the value of fiat currencies. Silver is more volatile, cheaper, and more tightly linked with the industrial economy. In comparing the performance of silver and gold since 1925, it can be seen that gold has shown a much better performance than silver. At the end of 1925, the price of an ounce of gold was $20.63. At the end of 2020, an ounce of gold sold for $1,893.66. Ultimately, investing in gold or silver can provide diversification, mitigate portfolio risk, and act as a hedge against economic uncertainty. In conclusion, a bank failure can be a scary situation, but there are steps you can take to protect your money. By creating a financial plan, building up an emergency fund, understanding FDIC insurance, diversifying your savings, investing in low-risk options, and paying off debt, you can prepare. Most importantly, do not fear or stress. I know this sounds counterintuitive given the subject matter, but getting caught up in the cycle of fear-based thoughts and actions only worsens the situation. Create a plan, trust your plan, and work the plan. For more savvy, smart, frugal tips, be sure to subscribe to this channel now. Cheers! Until the next time.